Welcome to part 2 in our series about beaten down beer stocks. In this episode, we're taking a look at Molson Coors, ticker symbol TAP, in our search for value in an overvalued stock market. If you missed part 1, make sure you check out the link in the description below. That one was on Anheuser-Busch InBev, ticker symbol BUD. Welcome to the stock sale flyer. My name is Aaron. None of this is financial advice. Let's go ahead and get into it. So as you can see, TAP is quite beaten down, similarly to Bud. There's some different reasons for that. I went into some detail about what's been going on in the industry in my video yesterday, so I'm not going to rehash all of that. A lot of it breaks down to changes in consumer preferences and creating uncertainty in the market. And I think that that's a part of what has led to a decline in share prices for the industry. But this is another brand with moat. Similarly to what I said with Bud yesterday, they have real estate in grocery stores. These are brands that we are familiar with. We see them when we go grocery shopping all the time. I think this is a business that's going to be around for a while. What it really boils down to is how do they manage the business and can they get the kind of growth going forward that they need? When we look at Molson Coors, there's a couple of things that have been challenges for the business that I like to note that I did not bring up for Bud yesterday. So there were some brand specific challenges for Bud that I mentioned in the video yesterday. For this stock, one of the things they noted, and this might be a industry-wide issue, but they note it specifically in the 10K here. I'm not sure if Bud did or not note this, but Molson Coors notes this. Cost inflation has been an issue for them. And they do note that they expect inflationary pressures to moderate and improve from those experienced over the last year. Some of their input costs, hopefully for them, those will come down, which will allow them to improve their overall margins. The other piece, as I was going through doing this valuation that I noted, was in 2022 and 2020, the fiscal years, they had negative net income. This is obviously something that I looked at, and these are concerns. I want to understand what's going on here. When I went back and looked at the 10Ks, they did note some different things in the items affecting consolidated results of operations. This is from 2022. This is the 2023 fiscal year report. But a large portion of this seems to be attributed to Goodwill impairments. And so hopefully, the brands going forward will live up to their carrying weights, and this won't be as much of a drag on their net income. If you're not familiar with Goodwill, basically Goodwill is when a company buys another company and they pay a premium for that business, they have to account for that on the balance sheet. And so Goodwill is where that would show up as an asset. If those brands don't live up to their carrying weights, they have to impair those and take that as a hit on their income statement. And that can affect their net income. It does affect their net income, and it can make their earnings because of that impairment decrease substantially. In this case, that was an issue. So what I did was I said, all right, well, I need to go into the 10K and I need to look at what is the status of their intangible assets and their goodwill, and are they at risk of future write-downs going forward. When I looked at their estimated future amortization expense for intangible assets over the next 5 years and compared that to what they've done recently, I didn't see this as a particularly big concern because it seems to be pretty in line and it seems to be decreasing as we go forward. Now, in terms of the impairment testing, I went through and highlighted some things to say, see, was this an issue or will this be an issue for the business going forward? I think it could be. Hopefully not to the same extent. It does. So it says that the fair value of the Americas reporting unit was in excess of its carrying value by slightly less than 15%, and therefore no goodwill impairment charge was recorded for that reporting unit. It actually says the fair value of the Americas reporting unit increased, which is a positive. Okay, so it's doing a better job of living up to its carrying value. They did note, though, that due to the current amount by which the Americas reporting unit fair value exceeds its carrying value, the reporting unit continues to be at heightened risk of future impairment. So, it could be an issue in future earnings reports. It's something to be aware of if you're looking at the business. They do note in here they're looking at focusing on growing their core power brand net sales, and they're also looking at expanding beyond beer. I think this is something we're seeing with these beer companies a lot. As people, like I talked about in the Bud video yesterday, people are interested in more non-alcoholic products and other types of drinks. And so the consumer trend in that direction seems to be leading some of these beer companies to look to expand their portfolios beyond maybe some of the traditional products that they offered. There's also the look at, there was an impairment here that is a part of their portfolio. It did say the fair value of the Coors brands in the Americas, the Miller brands in the US, and the Carling brands in the EMEA and APAC all exceeded their respective carrying values by over 15% as of the annual testing date. Basically, I think that there is a potential for more impairments in the future that could affect the net income, but I don't see anything in the 10K that says, they're only 5% above their carrying value in this particular brand or anything like that. So I'm not as worried about it going forward, but it is something to be aware of. And I would anticipate, some write-downs potentially in the future. Now, all that said, let's take a look at the valuation as a whole. Very little revenue growth built into this. So 1.2% for 2024, just over 1% for 2025, and just 1% in 2026, 2027, and 2028. Really minimal revenue growth. Net income margin of 8%. I think I could have actually gone higher than that. But again, like I said, with the Bud valuation yesterday, I want to be conservative with these numbers and really realistic with these numbers. So I went with 8% on those. And, if you look at the net income numbers just themselves, not a lot of growth built into the valuation, right? So in terms of the numbers, we're not getting crazy with the numbers here. These are, I think, pretty safe numbers unless the business contracts or they have other things that affect them, big write-downs again or things like that. With the free cash flow, I think I looked at some analyst numbers. I might even have just gone with those analyst numbers for 2024 and 2025. Can't quite recall 100% off the top of my head, but when I looked at these margins for free cash flow to net income, and then I looked at the Bud valuation from yesterday, they're pretty similar, right? So I think that, both beer companies, I think that this is a reasonable assumption that that's what they would do, especially when you look back. These numbers for 2022 and 2020, they're out of whack because of those net income, the Goodwill impairments and the other things that affected the business, but mostly, Goodwill impairments. But if you look at the years where the net income was healthier, last year, 148.33% margin for free cash flow to net income. So I think that, this is a pretty realistic number going forward based on what Bud does, based on what they've done in the past in healthy years. So I think that for free cash flow to net income, that's just fine. Good way to go. For the shares outstanding, so there's 4 share classes with this one. And there's a note, they actually have this investor frequently asked questions and they go through how the different share classes work. If you take the 4 share classes from the 10K, you add them together and you subtract the treasury shares, you get 213,300,000 shares. I went with the diluted weighted average shares outstanding number, or the diluted weighted average shares number from the last 10K, I should say, because I thought accounting for that dilution was probably a better way to go when I did this valuation. Here are the numbers for the weighted average cost of capital, 0.85 beta, the bond rate I used, and for the long-term debt, I had to kind of dig into this because when you looked at the long-term debt and the leases, the way that Yahoo Finance writes it up, they actually didn't have the leases built into that. And I like to look at different sources when I go through this. I like to use the 10Ks. I like to look at what Yahoo Finance says. Sometimes I look at what Fidelity has in there, whatever the sources that they have. I think it might be something related to S&P Global. I'm not 100% on that, but I like to look at the different sources and I like to reconcile them and figure out, which numbers, either how do these match up or which ones make the most sense. I try to get the best information I can when I do these. And so I went in and I went with I usually put the leases into the debt when I do these. So I went in and reconciled that difference and figured out that, okay, Yahoo's not accounting for the leases and the long-term debt. So I put those in. It doesn't make a huge difference in the valuation, but it does make a difference. So weighted average cost of capital, 7%. Discount, that's my discount rate. Just 1% perpetual growth rate. That's a small perpetual growth rate. I wouldn't be surprised if they exceed that. They should exceed that if they're running the business well. And so I get a fair value of equity here of $96.53. 2 share classes on the New York Stock Exchange. The one that's traded the most does the most volume by far. Closed Friday at $62.54. The other share class closed at $61.94. So really close in range. The difference with these share classes, I guess, you could go look at the frequently asked questions, but I guess the difference is voting rights. If you wanted to do more to account for the difference in that, you could. They trade really close together. I wasn't concerned about it really, especially where I use the diluted weighted average shares number. PE of 10 in 2028 with this net income and no change in shares outstanding. You've got $45.38. PE of 15, $68.07. PE of 20, $90.75. PE of 25, $113.44. So, if you wanted to use a higher discount rate, like when they did their impairment testing, they in the Americas reporting unit, they use 9%. Now, depending on what you're looking at, changes it. So they had a discount rate that was different here. I usually use a weighted average cost of capital in my valuations. You want to bring this up to 9%, 73.65. And bring it up to 10%, 65.47. Still higher than what it's trading at now. That's part of people deciding how they want to look at this when they put the numbers in and they tell the story. But I think looks like there could be some value here. They report earnings this week. We'll see what happens. Yeah, I haven't completely decided yet if I'm going to dive into this one, but both this one and Bud are looking pretty good. I'm going to do some more thinking on it. Like I said with Bud yesterday, maybe dollar cost average into it. So we'll see what happens. Let me know what you think in the comments. Is this something that you might be interested in? Obviously, none of this is financial advice, and it's just my opinion, but I'd be interested in your opinion. Follow me on X at Stock Sale Flyer. Make sure you like, subscribe, click the bell to get the future updates, and continue to join me on the channel. I'm looking at doing at least one more video in this beer stock series. So I look forward to seeing you here for that. Thank you. Take care.